Good afternoon and welcome to our weekly webinar. I'm Kathy Fettke, co-CEO of Real Wealth Network, and so glad you could join us today. I am going to hold myself accountable by looking at the predictions I had at the early part of the year around January, and if now in December I was even close to right or if I was just flat out wrong. So I've got my slides here from January and we'll just go through them and see where we are in the housing market in the end of 2019. Now I will be giving my 2020 forecast at our January event. So I'll be giving a little bit of it, but mostly this is our 2019 housing and review. And that's always fun to kind of look back at where we were a year ago and where we are now. So last year, my prediction was that we wouldn't run into a recession this year, but rather we would have continued growth, but a slowing down of that growth. And that would be not only in our GDP, but in the housing market, that we'd still see price gains, just not so fast, which is good. Things were bubbling along and it was prices getting too high, certainly in housing. So a little slowdown was actually a good thing. So that was my prediction. And in reality, we don't know yet. So I don't know if I'm right or wrong, but we just know that in Q3, the GDP for Q3 was 2.1%. So I would be right on for that. But we won't know until January or February what the final numbers were for 2019. But I'm guessing it's going to come in pretty close. But in my 2020 forecast in January, I will include that. So, but the bottom line, we did not have a recession. There was a whole lot of talk about it. There was headlines every day about this coming and looming recession, and it didn't happen. I didn't think it would happen. A lot of other economists didn't think it would happen. And I'll explain why I wasn't panicked for this year anyway. It really came down to the Federal Reserve policy. And if we look back to the beginning of the year, a year ago, well, a year ago would have been December of 2018, we had another rate hike last year at this time. And it was another rate hike of many rate hikes over the year. I think it was 4 in 2018. Now, what happens when the Federal Reserve raises its overnight Fed fund rate is its intention is to slow down the economy. That's what it's supposed to do, and it worked. Now, in the past, you can see from these lines, these are recessions. And what generally happens is the Fed, things start booming, booming, booming in the economy as rates go down, and it booms so much that it causes inflation and bubbles. So the Fed starts to raise rates. Boy, in the 80s they went crazy and rates were up at 18%, but that's because the economy was so booming they had to slow it down in a big way, put on the brakes. And when they do that, it's really to avoid out of control inflation, which is basically just prices going up too fast because there's too much money circulating. Then it oftentimes slows too quickly, and then they have to causes see this recession. Rates went up, recession. So then they have to lower rates to bring us out of the recession, and that's what keeps happening. But the Fed doesn't always get it right. So 2019 was really a year of interesting political battles between the president and the Fed for this very reason, because the Fed was on a mission to keep raising rates to slow down any bubbles, and it worked. The economy was slowing. But at the same time, we have a president who is running for re-election and doesn't really want to see the economy slow down. That was not part of his campaign plan. It's to grow the economy. So there was this unprecedented battle all year between the Fed, well, really the president and the Fed, the president doing a lot of name calling, saying he was going to fire. Just there was a lot of finger pointing and blame that the Fed was raising rates and causing this recession and didn't know what they were doing. And fortunately, or however which way you look at it, the Fed decided to stop raising rates and in fact lower them in just this past summer. And that really reversed everything, because when the Fed lowers rates, that's the opposite. That means that it's a stimulus. And when businesses hear that, when Wall Street hears that, they get excited. There's confidence and just a complete reversal. So at a time when there was so much talk of recession and all the tariffs, tariff wars, and all the Brexit stuff going on in Europe and negative interest rates, overseas, just lots of negative news. Here in the US, we saw this reversal, this stimulus that normally only happens when you're about to have a recession. So we could have been heading towards a recession, but it was averted basically when rates went down last summer. And Wall Street reacted, businesses were more confident. We saw a complete turnaround. Mortgage rates went down, but not because of the Fed rate, but more because of all this recession fear. So mortgage rates went down, which again, more stimulus. Then there was more QE that nobody's really talking about, but it was kind of under the covers, so to speak, and lots of, billions of dollars in more QE, which is more money going into the economy. These are all stimulus activities that are meant to rev up the economy some more. So at the beginning of the year, we were seeing an intentional slowdown. Halfway through, we saw an intentional speed back up. Again, this is not normal. Normally, the Fed keeps raising until there is a recession, at least in the past, that's how it's been going. So I would say it was intentionally averted, and here we are. And here's just another slide of that, just the Fed and how they raise and lower rates. We can see here there was the raising of rates, then it flattened, and bam, we got the recession. Well, we know that was a big recession in 2008. Didn't have everything to do with the Fed fund rate, but just kind of interesting to see that it happened after a bunch of, rates going up. But this was really more of the mortgage meltdown, those bad loans. But anyway, the Fed dropped rates to near zero levels for almost a decade with an intention of stimulating the economy. It worked almost too good. Again, that's why rates started to go up and up and up and up till things slowed down. And now we've had a reversal. And just recently, the Fed has said they're just gonna hold here for the next year. So we may just see a lot of slow and steady. And that's a really important thing to pay attention to when thinking about 2020, which maybe it's just kind of a flat year. If the Fed is not planning on raising or lowering rates, maybe it's just going to be a little bit more of the same in the coming year. So prediction number 2, I was thinking that unemployment would increase because remember a year ago, the Fed was really determined to keep raising rates and really slow down any bubbles that might be forming. And when that happens, we often do see recessions and that causes unemployment. But I didn't think it would be any kind of major crisis. It just kind of more back to normal because when you're under 4% unemployment, it's actually really tough on businesses because it's hard to find good people. When you find them, you have to pay them more, and then that cost is offset by prices, and that causes prices to go up because, of course, companies aren't going to swallow the cost of higher labor. They're going to pass it on to the consumer. So low unemployment is not great really for employers. It's great for employees, not great for employers because, again, they can't find the people they need to grow and they have to pay them more, and that can cause prices to go up. So anyway, I thought that we would see an increase. I was wrong. So my prediction wasn't too wrong, but it was wrong. Unemployment rate actually dropped from 3.7 to 3.5. Now, some people will say it's because more baby boomers are not working, but I think it really is because the economy is pretty strong for the most part without when you totally ignore the really underlying problems of debt, things are moving along. And that causes, more job creation, more wage growth, and more people buying things, which again fuels the economy for more production, more workers needed. So I was wrong, but only slightly. So we've got just a booming economy. In fact, we've got the opposite of what we've been saying we need. President Trump has really been harping on bringing jobs back to America, but we sort of have this problem right now where there's too many job openings and not enough workers. And yet we've got immigration policies that are pretty tight. So it's a little bit of a conundrum where we're revving up the economy, wanting to create more jobs. We already have a lot of jobs, not enough workers. How are we going to handle that? I don't know. But right now, if you are in the construction industry, you can feel the pain because you may have a wonderful project, but just can't necessarily find the workers to get that project done. And also this kind of lack of workers is driving pricing up in the housing market as well. So not only is there a lack of supply in housing, but there's a lack of workers to build more housing, which is going to basically contribute to the constraint on supply of new homes in the US. That's both good and bad, which I'll talk about later. All right, prediction number 3. I predicted that home sales would slow, and but even though the sale of homes, the number of homes being sold would slow down last year, we would actually see prices go up on the low end, but come down a little bit on the high end, simply because there's a ceiling to how much people can afford to pay. You know, you can lower rates to 0, but if people still can't afford the payment, then you're not going to sell houses. So something has to happen. Either people have to make more money, or the prices have to come down, or the interest rates have to come down. And we were actually at the time last year seeing interest rates go up. So I thought, okay, this crazy pattern we've seen of home prices going up over the past 10 years would slow down, but not stop. It's certainly not go into recession at all. And I was right. Well, actually, I was wrong on home sales. Home sales actually did increase, so that was surprising. Uh, Even with the threat of recession that was in every single headline for the first 6 months of the year, we still saw an increase in home sales. Home prices went up, and as I had predicted, this slide kind of shows that there was more closings than inventory on the low end, and that drove prices up on the low end in certain markets where there's job growth, and kind of slowed down on the high end properties around 800,000 and up to about 2 million, basically slowed, and we've seen more inventory in that range. And that's partly because that's the price point that builders can build at and still make a profit. We've experienced this exact thing in our subdivisions in Reno. If you're familiar with that, Meridian180.com in Reno, we're building 2 different kinds of houses up there. One is high end and one is more entry level. And it fits this slide completely. The entry level homes at Quest Reno are selling consistently, and lots of buyers for that. The higher end, the gorgeous 800,000 to $1 million homes, that really slowed down, which surprised us because the people moving there to Reno have pretty high paying jobs. And if they're coming from the Silicon Valley, man, an $800,000 home, it would be a 1-bedroom condo in San Jose if you're lucky. So to be able to get a gorgeous luxury 4-bedroom home with high ceilings and a yard and beautiful views just seemed like a no-brainer. But it just, again, you hit an affordability ceiling. So no matter how nice the property is, if people can't afford it, they can't buy it. So we have redesigned those high-end homes in Reno, and we're making them more affordable. And that's what a lot of builders are starting to do. They're trying to figure out, how do we still make a profit but build a more affordable home? And really the only way you can do that is go a little bit more vertical. So 2-story, even 3-story, and smaller pads, and kind of not as nice amenities. What I didn't see, and I was totally wrong on this, I had no idea that there was an increase, 19% year over year on the ultra prime. I mean, I hadn't even put that word in my dictionary for housing, but what we've seen is this ultra prime housing market that's remaining incredibly strong all through the year, while the prime housing market was slumping. So this article is just interesting. 2 decades ago, a $100 million home sale was almost unthinkable, but times have changed. 4 homes in the US have closed at or above $100 million this year alone. There was one just in Malibu, I believe, is crazy, with at least one more expected to trade by the end of 2019. Why? What is going on and causing this? Well, according to the Tax Policy and Urban Institute and Brookings Institution, this slide shows you that the tax laws really kind of were more beneficial to the very, very high end, which a lot of people don't like to admit or think about, but it seems to be true. So this slide shows that the bottom 20% didn't really get that much impact from the Trump tax cuts. The middle class got about a $5,000 bonus. This is averages. The top 20% got a pretty good deal, a $16,000 deduction on their taxes. The top 1% did real well, but look over here on the top 0.1%, big tax deduction. And where are you going to put all that money? Well, a lot of people don't want to put it in a bank. That's not really necessarily a solid investment. There's no insurance there. A lot of very, very wealthy put it in real estate. In Malibu, where I live, half of the homes here are empty. It's really sad, actually. But that is what we're seeing. The top income bracket earners are getting the biggest tax brackets and putting it into high-end real estate. Right. So anyway, the bottom line there is if you've got a $6 million house, this is a really good time to try to sell it. You might make a good profit there. Seems to be a market for it. Number 4 prediction, I thought mortgage rates would remain low. And I thought they would remain low in spite of what a lot of people were predicting, simply because I knew that last year the Fed was planning on raising rates the whole year, and that would slow down the economy. And when the economy slows down, people get scared and they want to buy mortgage-backed securities because they're considered safe. And so that's kind of how I thought it would play out, and that mortgage rates would stay low. And I was right. Mortgage rates came down. So prediction number 5, this took amazing intuition. Just kidding. Pretty obvious. I predicted that national and consumer debt would increase, and it did, because Americans are addicted to buying stuff. We've been trained to do it. 80% of our economy depends on it. We are here to just spend money, and we love doing it. And if we have to do it on credit cards, well, then let's just do that. And it's so easy now, right? You can just tell Alexa to buy stuff for you, and she does it. So, and go on Amazon. I mean, oh, it's just too easy to buy stuff these days. Anyway, people are doing it, and they're doing it on credit. Prediction number 6, demand for rentals would increase. Once again, I'm not sure I needed to be an intuitive genius for this. It just seemed obvious, and I'll explain why in a minute. But yes, with household formation, you have to ask yourself, okay, we're seeing an increase in population growth. We're seeing an increase in household formation. But what are they going to do? Are they going to buy, or are they going to rent? And my prediction is that more would rent. And that's what we're seeing. Now, this article came out. I put it in our newsletter last week, and I just was blown away by it. I had to read it like 3 times to make sure I was reading it right. I knew that I thought it was about 25 million. I think it is about 25 million, because this is from 2016. 25 million more people than there were from the last time we had a recession. So our population is growing. What I didn't know is that when you look at the increase of renters in that same time period, it was 23 million and only 678,000 new owners. So if you look at the way that the population grew versus the way home ownership and rentership grew, not looking good for homeowners, really looking good for landlords, though. It's sad. And again, I've given this speech a couple times this past couple weeks, and what I'll tell the audience is, with every challenge, there's an opportunity. With every opportunity, there's certainly a challenge. But this, to me, is one of the biggest opportunities out there in many, many ways. One is, if you're a real estate agent, you got to get out there and teach people how to build wealth through real estate, because you've got 23 million renters, new renters, who are not going to be able to build wealth through real estate, and maybe don't even know that they should, or why. They haven't been taught. But imagine 10, 20, 30 years from now, the owners are going to be locked in to a fixed rate if they don't refi at today's low mortgage rates at 3.5% or whatever you can get for 30 years and locked in. But rents, are going to be going up 3 to 4% every year, most likely, such that in 30 years they're going to be paying 2-3 times what rent would be today, and have nothing to show for it. Whereas the owner will be locked into the same payment, which will be very low because it'll be today's rate, when we know there's inflation, and they'll have their loan paid off by then. Every payment goes to pay off the loan. So if you are looking for an opportunity, this is one. You got to teach people. This is my mission, is to teach people how to build wealth, and not be stuck at age 60 going, oh, shoot, I probably should have done something different 30 years ago. So, well, again, the opportunity for people looking for an investment is that there's a whole lot of people looking for a rental property and you can be their landlord.